Good afternoon, everyone. It's 12 noon sharp. Welcome to our first Global Investment Strategy session for this year. I'm looking forward to sharing with you some of the key things we're looking at. I'm going to try and cover as much of it in as much detail as possible. And in the event that I miss out on anything, don't worry, we're going to have another go at this when we meet you effective from Friday. So thank you so much for making your time for us. I'm going to pretty much start off now. I'll start off with just a recap. I think a reminder rather that we follow a macro regime-based asset allocation, meaning that our risk appetite, or the expression rather of our risk appetite as far as growth asset is concerned, is really a function of the strength of the business cycle. We pretty much just run under one mantra. For as long as the business cycle is strong and stable, much of our growth asset exposures should be neutral to overweight. But the moment there's quite a lot of significant downside risk to the business cycle, because it does translate into significant downside risk for earnings, we typically tend to start to focus on yield using local and global bonds and start to shy away from growth assets, all else equal. One of the most predictable ways or most reliable indicators of the downside risk as far as the business cycle is concerned is the US yield curve. And every time that it is inverted, 80% of the times we've actually ended up experiencing an economic growth recession as well as earnings growth recession. And typically the contraction of both earnings and economic growth are indeterminable at the time of inversion, but it normally does signal danger. We are there now. We've been at this state, I think, of the business cycle since May last year. And essentially, for as long as the yield curve is inverted, we're going to maintain a maximum focus on capital preservation, meaning that as much as we want to experience growth in our portfolios, that is no longer the priority. Our priority is on protecting capital until we feel the risks to the downside have pretty much transitioned to favor growth. The reason why we do that is this illustration, which we've been sharing with you, I think, for much of last year. And I'm going to pretty much look at this from so many different angles. So we're going to start off with earnings. Ideally, when a yield curve is inverted, it means the business cycle is weakening, and typically your earnings start to weaken. Earnings typically sell off by roughly 35% during a deep economic recession. And during what we call like a soft landing, you can expect earnings weakness of anything between 15 and 20. If you look at the first like small, I guess, text box to my far left, it gives you a sense of how to arrive at the valuation of equities or an equity market using what we call the dividend discount model. Essentially, what that requires of the analyst is to get a sense of the sustainable earnings of any company over the long term, and then divide that by whatever the discount rate is. As you can imagine, when your yield curve is inverted and the central banks are still hiking rates like the Fed is doing now, and there is a lot of risk on the earnings, there becomes uncertainty on two levels. You don't know what number to use for the earnings because you have no idea how severe the recession is and how it's going to affect the different companies. Equally, you don't know also what interest rate to use because it's unclear how far is the Fed going to go, how long are they going to stay at that rate, and how fast are they going to cut rates if they ever get to that point. So, but essentially, if you look at this particular chart, to get a value of this equity market, it's just the earnings divided by interest rate, both of which are never clear when there's a yield curve inversion to give you the valuations. If you study the progression of earnings in this particular chart, where they're declining by 10% ago from 100 to 90 to 80 to 70 to 60, what you realize is that the contraction of earnings is a little bit easier to understand as far as earnings are concerned. Meaning that if we are expecting anything between a 20 and 30% contraction in earnings, essentially it translates in a linear fashion to your downside risk, which moves from 20 to 30. The problem comes when the problem actually arises when you start to think about it from an interest rate perspective. So if you assume earnings are pretty much flat, which they have been since the yield curve inverted, it's only now we're starting to see some level of earnings weakness, but for most of last year, earnings didn't really move. In fact, they were growing. if you divide that by the interest rate, you start to see that the effect of interest rates on valuations is slightly more exponential. So for 100 basis points increase in rates, you're pretty much expecting a 17% downside. If you increase that by 200 basis points from 5 to 7, you're looking at almost 30% downside. The Fed has hiked rates by over 400 basis points since they started, meaning that essentially we're looking at a rate hike from 5 to 9. Obviously, in their case, they started at almost 0 to current levels of between 4.25 and 4.5%. But you can see that that easily translates into 44% downside risk, all else equal. What we're very concerned about is an environment where the market starts to combine earnings weakness and rate hikes. And it's very difficult to know just which of these combinations we're going to have to use. But what's quite clear is that as soon as you start to combine earnings weakness and rate hikes, the downside risks are quite material. So let us assume, for example, that we have a soft recession of just 20% earnings contraction, and we also apply a 200 basis points of rate hikes, although we have actually high rates by more, you're pretty much looking at 43% downside. For the S&P 500, the sell-off of last year was equated to just about 17% downside, meaning there was still another 20% to go, all else equal. But we then subsequently had a rally of about 10 or 15% since the October lows, meaning that the downside risk is pretty much expanded back to 30 or 40. But the short, I think the only thing I think we can leave you is that we definitely know there's some earnings contraction that is going to happen in this particular cycle. We also know that there have been rate hikes already equating to 400 basis points. What is unclear is just how bad are earnings going to be knocked. But if you apply that to a 400 basis point increase, the downside risks, take your pick, there is still material downside risk in this particular market environment. What's also very concerning to us is that it's one thing to incur the downside risks, as you can see in the far right, but also to make up those losses once you've experienced them requires your portfolios to work even harder. So for example, if you just look at a 10% earnings contraction and only 100 basis points of rate hikes from 5% to 6%, you're pretty much looking at downside risk of 25%. But to make up for that, equity markets have to sort of rally by a good 33%. So following a macro regime-based model allows you to sort of reduce risks as soon as the yield curve is inverted, so that you reduce the amount of your portfolio that is affected by these downside risks. Equally, it allows you to raise enough dry powder to allocate to capital markets so that you spend a lot more time in capital growth as opposed to recovering. Because as you can imagine, you don't want to waste the full 75% upside making up for losses as opposed to experiencing or benefiting from some of the growth. So this is pretty much, I think, where the BIP house view is. For as long as we're not so clear how weak earnings are going to be and where the Fed is going to pause, we feel it is an environment where the risk of losing a lot of money if you're wrong is very, very elevated. So we are expressing a very clear capital preservation focus, or else equal. If you look at it from a different angle, this is pretty much, I think, the anatomy of a bear market, which we did share for many quarters with you last quarter, where it's pretty much saying typically the first 20% of any equity market weakness is a result of interest rates. And then the second 20%, as you can see, is because of earnings. And then typically when you enter the space, investors typically tend to panic because they start to extrapolate this into the future. And then you've got a final one pretty much of that comes out of liquidation. We're not obviously expecting to go all the way to this part, but if I look at these numbers that we've sort of shown you here, the combination of a 20% earnings contraction, or rather 30% earnings contraction and 300 basis points of rate hikes easily creates a 56% downside, which is actually not so different from what this chart implies. It's not important to decide how worse it can get, but it's very important to really preserve as much capital as possible. What makes this particular cycle extremely difficult for us is the fact that this first sell-off we experienced last year, we can obviously say maybe it was because of rate hikes, which is possibly not a lie, but it's also very obvious that what we saw in 2021 and 2022 was over earning capacity from a lot of companies because of the COVID grants. So we could easily say what we experienced last year could easily because of the unwinding of extreme rally that was caused by too much stimulus. And we haven't really seen the part where interest rates and earnings kick in. So essentially, it's a cycle which had an aggregate demand shock, where last year might be because we were unwinding that shock, but have not yet started putting in enough allowance for rate hikes and earnings contraction. No one really knows what the answers are. But what we do know is that it is probably the most responsible thing to just keep some money out of growth assets until it's very clear what's happening with equity markets. And that's pretty much where we are with our house view. So if you sort of come back to process, because it's very difficult, if you look at how to look at investment strategy, where we look at the macroeconomic backdrop, the business cycle, asset class valuations, currency risks, and etc., what you can immediately tell is that many of the ways of determining risk appetite after this red text box require you to have a very strong view on earnings. Because the yield curve is inverted and we're expecting earnings contraction, but we don't know how bad it's going to be, it doesn't make sense to make a decision based on valuations when the earnings number you're using is wrong. So we typically tend to suspend these valuations when the risks in the red text are very elevated, which is where they are. And we start to position for what we call a euphoric scenario, where there is no clarity on fundamentals, but equity markets sometimes rally like they've done November, December, and January. In any case, for us, as soon as we enter that state, the first thing to do is to remove all your active exposures to growth assets and go for a neutral exposure. And as those signals become more and more dangerous, we start to build more and more defensive buffers, which is what we did in July, as well as what we did in August. And in September, we concluded our de-risking strategy, which we have retained up to this particular stage. The graph that you've seen here, which is also very familiar, I think, with all of us from a BIP process perspective, really just gives you a sense to say, if you divide any equity market into 10 different but equal parts, regardless of the length of the cycle, typically the strongest performance you get in the early stages of the cycle, and the second strongest you get in the very last part, which also happens to be extremely dangerous. So I think just to remind you to say, we are aware that there's always going to be relief rallies like one we're experiencing now, but these are not the type of equity returns we feel we are able to exploit, in the sense that it requires you to be extremely good in terms of your timing out of that before the equity market crashes, and to be able to sort of buy back in. We feel the ability to rather raise enough capital that you can allocate back gradually into the stage is a bit of an easier call. So you will typically find that when we have relief rallies like we've heard since October, our funds tend to struggle for that reason. And I'll take you through a very brief performance attribution of how we've performed since we de-risked our portfolios. The other thing worth noting is that how long is understanding, some time guidance around these things. And the first chart I think you can see to my far left is work done by the Bank of America Merrill Lynch to try and study how these different regimes typically last for. So for example, we've got a macro regime, which we call bounce, which is that very first powerful stage. To get a sense, how long does this typically last for? If you look at many cycles, this has lasted for roughly 5 months, but the average duration has been 2 months, meaning you really need to have the stamina to buy back as fast as you can as you see more blood on the street. And then I think the one that's very, very important is pretty much this euphoric regime, which is where we are. And if you look at history, that really is typically anything between 0 and 34 months. We're pretty much 7 months into this, suggesting that there's another 27 months to go, which is, I think, an easy way of just saying this particular state in which we are in could prevail for most of this year, as well as for most of next year. And we'll only get out of this pretty much as we head into 2025. So because it could be a long time for these things to play out, because cycles are very complicated, it's very important to us that as much as we're de-risked, we start to have a very good way or good plan to say, how are we going to be buying back into risk so that we capture as much of this as possible? And this is pretty much, I think, what we would call the BIP re-risking strategy, which we shared with our clients in the third quarter of last year. We shared with all of you again in the final quarter of last year, and we are going to share that with you again in the meetings that we're going to have this quarter. But what is very critical, I think, to us is that every client approves this re-risking strategy, because it does give us the ability to start to nibble back into the market as fast as possible. Otherwise, the current strategy where we have to sort of consult with you, you approve, and then we implement may not work for if we want to capture as much of this as possible. So there is a strong encouragement on our side to really approve our re-risking plan, so that you can make our execution of the re-risking strategy as efficient as it needs to be. Talking about re-risking, there's quite a few things that we're very aware of. One of it being that as soon as you manage to build enough dry powder, so if you sort of look at our performance profile, we've probably managed to build a lot of dry powder during this first 6 months during the first 6 months of the yield curve inversion. And I think if you sort of look at this study, when you're sort of trying to take profits or get out of the market, if you do it a bit too early, you sort of miss out on the upside. If you do it 6 months a bit too late after the peak, you sort of miss about 10%. We would clearly have lost out on this 10% because it is very difficult to time these things correctly. But fortunately, I think we sort of are still safe from the remaining part of it. And if you sort of look at the first 10% of loss compared to the potential 50% that we have shown you here or here, I think we've pretty much done a decent job on condition the cycle is going to evolve as we expect it to do so. What's clear, however, is that the danger of re-risking too early is far more destructive for capital growth than the one of taking profits. So we are quite aware that as much as we have a clear re-risking plan in place, we have to be extremely patient in how we execute this, because if we move into risk assets too early, historically, there is a very high chance that you lose about 23% too early, but equally, you cannot also take too much time to sort of balance out, meaning that we're going to have to figure out how to be patient on the other hand, but also not become too cautious when the opportunities start to arise. And when you study our re-risking plan, you're going to see we've put in a lot of things to look at, which is hopefully going to allow us to be able to do that and not introduce way too much downside to your portfolios. Key point being, patience is going to be very, very important. And a simpler way of doing that is, once you have dry powder, hang on to it for as long as is necessary, because it is quite critical that you don't lose out having done all the work you've done. And we really are in that camp. Refreshing your memory again on just this idea of like a Fed pivot and application of dry powder, which is where we are. There are 3 charts which study market performance profiles, which are linked or correlated to Fed hiking cycles and Fed cutting cycles. What I really want to draw your attention to is the solid blue line in all the 3 charts. These 3 charts are looking at 3 different scenarios. The first one, which is the top left chart, looks at a scenario which studies the average performance of many equity markets 12 months on average after the first rate hike. And then we also then have the average performance of many equity markets 12 months after the first rate cut. And then the final one is the average performance of equity markets 12 months after the final rate cut. And I think what you can pick up from all these 3 different Fed cycle regimes is that typically 12 months after the first rate hike, markets tend to perform by roughly 6%. But if you really get it wrong, the downside risk here could be as high as pretty much a -20, meaning that when you look at performance profiles, things are really skewed against you. And then if you sort of look at the second part, where we look at the performance of equity markets 12 months on average after the first rate cut, which we think is what markets have been celebrating since October, where they feel the Fed is very close to a pivot. Sadly, that pretty much comes with very flat markets. And in some cases, the downside risk is a lot worse than in a rate hiking cycle. And I guess the reason really comes down to the fact that it is very rare for the Fed to stop cutting rates unless something in the system is broken, or unless they've introduced extreme fundamental downside risk, which they're trying to protect from. And then if you look at this last chart, it pretty much says the sweet spot for equity market performance typically is the 12 months after the last rate cut. So I think the reason why we're sort of taking you through these three scenarios is to again emphasize to say, we have raised quite a lot of dry powder across your portfolios. We're pretty much sitting at anything between 15% and 20% of dry powder. It is sitting in fixed income assets, primarily bonds, where you're earning a very good yield of 11% on the local side and now 4% in dollars on the global side. So there really is no need to rush that in, especially if you sort of look at these scenarios. So again, emphasizing the importance of being very patient until a lot of very complicated macro dynamics have played out. And that's pretty much where we are. And then on that basis, I'm going to sort of quickly take you to Q3 of last year to give you a sense of what type of portfolios did we build after the de-risking that started in May and we concluded in September. I'm going to then do the same and give you a sense of how did this work out for us in Q4 of last year. And after we've done that, we're then going to give you a sense of where do we stand now? How do we want to position the portfolios for the first quarter of this year? And what are the main considerations? What are the things we're looking at for the rest of this year? So going back to Q3, when we started the de-risking process, our final portfolios pretty much looked like something like this. Not every client's portfolio looks like this because we do allow our clients to then adjust our recommendations for their own risk appetite. But for all clients whose positioning is 100% aligned to the BIP house view, what you will find is that when we concluded this process, we were 10% underweight South African equities, reason being that South African equities are a very cyclical idea. And typically in a very deep recession, cyclical ideas tend to sell off far more aggressively than your defensive ideas. And the other issue being that unlike global equities, where some of those losses are offset by rand weakness, with South African equities, unless you've got a derivative overlay over them, like managers like Alan Gray do or Avex do, pretty much a lot of those losses are naked losses. To the extent that much of our exposure as fund of funds cannot be hedged out, this is our naked exposure where you pretty much want a larger downside risk management exposure, which is why the underweight there is quite extreme. It also has to do with the fact that the resources sector has become a bigger part of the South African equity market, and a lot of those earnings got exaggerated by the Russia-Ukraine war and are at very high levels, which are not normal. So pretty much if those earnings come back to normal and then start to reflect a recession, you might find that the loss in this particular cycle for South African equities is a lot larger than would have happened if we did not have the distortion of over-earning capacity created by the Russia-Ukraine war. So pretty much, I think that explains why our exposure to South African equity has got a bigger underweight or else equal. South African real estate has got a slightly lower real estate underweight because our strategic weight there is 5%. So pretty much that is 2% down, cutting to 2% is quite significant from that context. I'm going to sort of go straight to global equities. At this particular point in time, our global equity exposure was a 5% underweight. And we sort of implemented this in two ways. I think the first part was we acknowledged that earnings in the Chinese equity market were extremely depressed because China had been engaging in very restrictive fiscal and monetary policy to contain a lot of systemic risk. So the equity market was pretty much bombed out. So the first thing we did was to reduce a bit of developed market exposure and allocate that to Chinese equities. So there was a 5% reduction from DM equities into Chinese equities. And then after doing that, we then cut back both DM and EM by 5% combined to create this 5% underweight. Global real estate, which came with a strategic weight of 5% like local real estate, also got cut back by 2%. So effectively, what we then did is we created dry powder with 7% on the global side and then dry powder with 12% on the local side, which pretty much created a 19% defensive block or else equal. Because the dollar was extremely expensive and there was a risk that it could weaken, translating into rand strength, which would then cause a lot of currency losses on the global fixed income exposure, because as you can imagine, at that point in time, your yields were still very low. Much of that money was brought into South Africa, into unconstrained flexible fixed income guys, these being managers that can really allocate between cash and bonds in a very aggressive way. And then some of it we allocated to South Africa nominal bonds where you're getting very, very good yield. So the beneficiary became a 5% overweight with nominal bonds and a 14% overweight with unconstrained fixed income managers to create that 19%. And then for global bonds and global cash, we pretty much kept these risk neutral, and combined, this would have been an allocation of roughly 5%. And because of that, it then resulted in us having an overweight South Africa stance, really because we felt that if the rand strengthens with very low yields on cash and bonds, it was going to create too much currency risk at that particular point in time. For our global multi-asset portfolios, we cut BIP Global Equities by 10. We cut global property by 5 because the benchmark weight for property here is 10. The benchmark weight for global credit in a lot of these strategies is also 10. So we cut that by 5, creating a 20% defensive block that went into global bonds and global cash. Here, you don't have to worry about our rand dollar issue because these are pure global multi-asset portfolios. And then for strategies where we are running a combination of different balanced funds, we pretty much just retained an equal exposure to each specific style and raised a defensive block of 15%, which was again allocated to a combination of nominal bonds and unconstrained, depending obviously on the risk appetite of the client. The very aggressive clients allocated all of this to nominal bonds, and our slightly cautious client actually split this up in different allocations, but key being that we emphasize the yield of South Africa fixed income and the much reduced capital growth risk. Now, to give you a sense of how that worked out for us in the very first quarter, if you look at the performance profile of your growth assets, I'm really going to focus on the South African All-Share Index. Over that quarter, it lost 1.92. In the final month, when we were concluding our de-risking process, the All-Share lost 4%. And then if you also come to local property, in the final month when most of our de-risking was done, local property actually sold off by an aggressive 6%. And for the quarter, it pretty much lost about 3.54%. And pretty much we avoided all of these losses and benefited, I think, from your local bonds, which were up by 0.6%. Granted, in September, we're that scare of the UK gilt market where whilst we were really hoping to make a lot of money from South African bonds, they also participated and lost this minus 2.11. But I think from an attribution perspective, what you can see is that this minus 4 is worse than minus 2, and this minus 6 is also worse than the minus 2. So regardless of how you look at it, generally, the fact that we had more defensive assets did help us a lot on the local carve out of our portfolios. If you then look at it on the global carve out of our portfolios, by reducing global real estate, it doesn't really matter whether you look at it from a local perspective or from a quarterly perspective or from a monthly perspective. This did help us in the sense that it was worse than what your global defensive assets did. And this is also worse than what the local bond exposure did at 0.6. I'm going to use 0.6 because some of the money we would have taken from global came onto local. And then if you look at what the world index did, it was up by 3%. So there, I think that didn't really work out for us for the local bonds, but for the global bonds, it was a bit beneficial. And then if you then look at what really did not work well for us is the fact that when you look at this developed market exposure of 3.03%, and you compare it to what emerging markets did at -2, what is in fact, it's actually Chinese markets I should be looking at. This discrepancy between world equity markets and the Chinese markets did not work well for us because a lot of investors started to worry about the Chinese National Party conference, and there was a lot of concerns that President Xi Jinping would come back to power, which subsequent to that he actually did. So we pretty much got squeezed on what looked like a de-risking process. It ended up actually burning us. But all in all, in the first 3 months of this process, things look like they really worked well. What would have also backfired is the fact that whilst we were very scared that the rand was going to strengthen on the back of an extremely strong dollar, it surprised that it actually strengthened. So if you look at the USD-ZAR relationship in the first 3 months, you can see how the rand actually weakened by another 11%, suggesting that if we had kept that money in global cash, it was going to work well for us. But as you can imagine, I think the downside risk for the rand there was over 30%. It could have gone the other way around. But nonetheless, in the first 3 months, this was not a positive thing. So I think we can conclude to say generally the direction as far as growth assets are performing worse than defensive assets locally and globally. things worked well for us. Where we didn't really what didn't really work well for us was that 5% we allocated to Chinese equities, as well as missing out on some of currency weakness. So it was pretty much the Chinese core and the rand weakening more than we anticipated. That did not work well for us in the first 3 months. So if I sort of just summarize that, local defensives added value in the sense that they outperformed the local growth assets, all else equal. The global defensive generally did well, but within DM growth assets, within the global side, your DM outperformed China. This really squeezed us. So this was the first, I think, thing that really didn't work well for us in the early stages of our de-risking. And the second part being that we actually ended up experiencing much more dollar strength than we imagined, and that hurt us. But overall, we feel like the strategy was directionally correct. And also, we do know that it was pretty much only 3 months into the story, which we expect to play out for another 27 months. So maybe a little bit too early to look at that. But nonetheless, I think it's a good thing to just have a sense of how things are working out. The biggest risks we noted, I think, on a forward-looking basis is we were so worried about continued dollar strength because we were very reluctant to hold a lot of dollar cash when the dollar was so expensive. But we're very aware that the dollar could remain stronger than we could stomach. So that was a very big concern for us. We were very worried about global relief rallies, global relief bear market rallies, rather. I think that's an easier one to pronounce. We're so concerned about bear market rallies, but equally, we're not willing to participate in them because of the downside risks they came with. And then the issue of DM growth assets outperforming EM growth assets, especially China, although China had much, much lower earnings than DM, was a concern for us, especially because we had experienced a lot of pain from that. And we also worry that our onshore assets would continue to underperform the global assets, even though that was the safer thing to do from a valuation context. And then finally, we just worry that as much as we're starting to participate in bombed out earnings and bombed out GDP for China, the policymakers would continue to self-sabotage and it would work against us. So this is pretty much how we closed the third quarter of last year. We then moved into the fourth quarter, as you can see, and had more meetings with you. And essentially, what we then started to position in the fourth quarter was a de-risking, a re-risking strategy. And I think what we communicated was to say, as much as we really want to exercise as much patience as possible with our dry powder, we were very aware that we needed to have a re-risking plan as a lot of our calls started to work through. So I think we pretty much positioned before you a 14-plan re-risking strategy. And I think one of the things we pretty much looked at was to say, if China was going to surprise us and go out of our lockdown with all of the dry powder they have from a savings, they were going to affect our cyclical areas like Europe, UK, and South Africa quite constructively. So we pretty much put a re-risking plan to say, let us have a look at how the global macroeconomic picture and the business cycle picture is going to play out for these main cyclical regions. And if China does come back and they announce a policy stimulus package that can influence these areas constructively enough, we would then have to reduce our South African equity underweight from -10 to -5. It would be irresponsible to close it out until the US recession fully played out, which is why we're not pretty much closing all of it. I think there's also other issues where we talked about what do we do when the Fed pauses hiking interest rates? And I think we made a decision to say, if they do pause hiking interest rates, we need to make sure that we maximize all of our allocation to high duration asset classes. And here we're talking about South African inflation linkers, global inflation linked bonds, South African nominal bonds, and global inflation linked bonds, which we've subsequently started to increase, but obviously we're not there yet where the Fed is paused. If you look at the decisions we've proposed, none of these talks about equities because of the earlier example I showed you to say, typically a Fed pivot has never been good news for growth assets. So you'll see that even with us, the Fed pivot does not actually allocate any money to equities, but rather to asset classes where we're maximizing duration, because as your rates are cut, bonds tend to rally before equity. So you want to make sure your strategies has got a lot of bonds, as many bonds as possible. We also have on number 3, when the Fed actually starts to cut interest rates. And if you look at our proposed decision, it is still more focusing on asset classes which have got a link or a relationship to fixed income duration, which in this case is DM real estate. I'm not going to really take you through a lot of these re-risking criteria, but when you study a lot of these are things that would make the support for a business cycle and earnings a lot stronger. So I mean, one last one is a peak in the dollar, which starts to move towards dollar weakening, is very bullish for commodities, which is good for the South African equity market. It's bullish for emerging markets, and it's generally a constructive thing for global earnings. So you would have to almost like consider that and assess how to affect portfolio positioning. So I think many of you will receive this tomorrow or today when we start to give you recommendations of how you want to position your portfolios for this quarter, but you would also have received this in Q3, and you'd have also received these 14 points in Q4. What I really want to leave you with is that everywhere you see a shaded line, it means that that particular criteria has been triggered. So last quarter, for example, our two main research providers, Up and Macro and BCA, came out with strong arguments to say that dollar had reached its peak. And because of that, we had to start considering ideas like gold as an example. And I think for in our communications last quarter, we pretty much mentioned that there is room to start to consider things like gold, all else equal. Another trigger that was triggered was that aggressive sell-off in bonds triggered by the US equity market, by the UK gilt market. And essentially, I think we made a call again was made by them, BCA and Up and Macro, that as far as this cycle is concerned, it was going to be unlikely that bonds were going to go higher than the 4% they reached last year. And on the back of that, you'll recall that we did send a recommendation, I think, to as many of you as possible to say, let's close our global cash allocation and move that to global bonds and introduce an overweight to global bonds on local mandates and global mandates to position for the fact that we are now getting to a stage where the bond market might stop worrying about inflation and start worrying about a recession, in which case it would rally. We also had this triggered where China essentially concluded their Congress and the market punished it because they re-elected Xi. But later on, we did a deep dive into the Chinese story, which I know we shared a lot of the insights with you. And a lot of the Chinese experts we spoke to actually confirmed that the global investors had reacted to the Chinese outcome incorrectly, and we pretty much increased our exposure to China, although it didn't really work well for us in November and October, but in December that course started to turn around. But in any case, you'd have also received a call from us to increase your exposure to Chinese equities or EM real estate if you could. For those clients who are exposed to the best blend global equity, it does have exposure to EM real estate and has benefited from the recovery of those EM property stocks. But I think for the majority of our clients, it was expressed by buying Chinese equities worth 5%. And unfortunately, for the last quarter of last year, this backfired. But in the last weeks of December, moving into January, it has started to work out. So it really left us with a bad performance outcome in 2022, but fortunately still recovering. But the key point being that there is a 12-point criteria where as things happen, we're ticking and we're changing your portfolios accordingly. So far, 3 calls have been made, which then allows us to re-risk gradually and hopefully responsibly. So if we look at how did that affect your portfolios in November, so if you sort of look at where I have these 3 asterisks, it gives you a sense that in November, this is what we're implementing. The first thing we did is that we closed our global cash exposure, or we removed the 2.5% and we took 2.5% from global cash, allocated that to global bonds for South African multi-asset income portfolios. For the global multi-asset income portfolios, we took 50% of whatever the cash weight was. Cash there was roughly 10%. So we pretty much took out that and we allocated that to global bonds as well. And then if you look at what we also did is global equity, which was underweight by 5%, we restored back to neutral. But this was restored back to neutral by buying Chinese equities as the global investors sold that equity market again, because we took the view that that was actually the incorrect response to the National Party Congress. And so essentially what we added is we added 7% worth of risk in November. 5% of that risk was equity market risk. 2.5% of that risk was high duration fixed income risk when we bought bonds, and that was funded by that 14% allocation to unconstrained fixed income, which was subsequently reduced from 14% to 7%. We also pretty much, I think, had a discussion with some of our clients to say if any of the clients were brave, they could consider gold instead of global bonds, or they could consider global bonds and gold and introduce a 2.5 allocation, because if the dollar had indeed peaked, that was all else bullish for gold. We'd not really have a lot of takers for gold, but we definitely had a lot of takers for the Chinese equity call and the increase in global government bonds. We are still advocating for more global gold exposure because a lot of the factors are aligning in favor of this asset class, and we'll be positioning that, I think, with you when we meet you effective from Friday. But this is pretty much the portfolio that many of our clients actually ended up having come December, when a lot of the trades had been implemented. On the global side, it's exactly the same thing, where we reduced our global equity allocation from -10 to -5 directly into Chinese equities, and we bought 5% additional global government bonds to really maximize the fact that yields had peaked, and this pretty much became a 15% overweight exposure. For the multi-asset portfolios, we didn't really do anything, but to the extent that the Present China Fund is a multi-asset class fund, we did position up the possibility of an allocation of anything between 5 and 10% with clients who are interested. We are still actually advocating for this, but as you can see, it is an optional call, because we do understand that this is meant to be a very simple vanilla strategy, but for opportunities like this, we do make exceptions. So for clients that are still keen on the China story, especially because it's starting to gather momentum, we would still recommend an allocation, especially through this fund, because there is a lot of risk management that happens within it. Now, I mean, our biggest nightmare became true. The relief rally that we had listed as a headwind when we introduced our de-risking actually happened, with the local equity market rallying by 15%, whilst our bond exposure rallied by 5%. So pretty much bonds underperformed equities by 10%. And because there was a 10% underweight South African equities, it pretty much introduced a 1% underperformance in the 3 months to close the year. Interestingly enough, the local property market, despite all the exposure it has to Europe and UK, where there's quite a lot, there's a higher conviction that there will be recession, that rallied by almost 20%. So what actually had ended up happening in the final quarter of last year is that we got a very strong squeeze of this de-risking call because of this aggressive relief rally. Yes, in December, the market started to weaken and reaffirm our calls again. But as you can imagine, this is a lot of pain that was inflicted on us, which is going to show in the 2022 numbers, unfortunately. If we move over to the global side, again, a lot of pain was inflicted on us. If you look at the MSCI World Index, it rallied by 4%. Obviously, it gave back that, but still there was this rally of 4%, which if you compare to what happened to DM bonds, this was a loss. Fortunately for us, most of this money was taken to South African bonds. So if you compare the 44% performance of DM versus what you have in South African bonds, this was probably not a train smash. What was a train smash, this was probably not a train smash, actually, so my apologies. So on the global side, this 4% was a positive number, but fortunately it's in South African bonds, it worked well. What hurt us is actually the South African equity versus South African bonds, this distracted value. On the global side, it's a bit of a mixed bag. And then if you sort of look at global property and you compare that again to where the money was, which is South African bonds, our underweight global property in favor of South African bonds did work out well. But this call really bent us a lot. But to the extent that this is a very cyclical asset class, we still feel we should hang on to that particular idea. What sort of started to add a bit of value is this 7% rally that we saw in the Chinese market, and which pretty much, I think some of it came in the final month of the quarter. Some of it came as we were building exposure. So it's a bit of a mixed bag, but all else equal, there was a relief rally that hurt our performance on the local side, which you're going to see really left us in a bad place in 2022. And then if we look at defensives on the local versus global, the idea of local defenses being a better play than global defenses because of the rand risk really started to play out again. So I think what I can leave you with is that the de-risking strategy is generally working, but there's quite a lot of volatility in markets where we make up for it. For example, we lose on some, But in general, I think it is generally in our favor. And the biggest pain has come only from the local relief rally. I think that has hurt us. The other ones have really played out exactly as we anticipate or exactly as we expected. What we sort of like is that in the final month of the quarter, the Chinese equity market started to outperform the South African equity market. So our decision to re-risk directly in China paid off. What we have seen so far in January is that the Chinese equity market and the local equity market are rallying to the same degree. So I think both are up by the same amount, again, meaning that that call is actually working. But as you can imagine, there's still a lot of bad numbers that it left us with because of what happened in Q3. So this is pretty much, I think, a summary. If we look at Q3 to 2022, pretty much, I think we did well in terms of the de-risking strategy, but we got really squeezed out when your global investor overreacted to the Chinese conference and the dollar strengthened more than we expected. In Q2, as I've showed, the dollar call started to work in our favor. The Chinese call started to work in our favor, but it came in a little bit too late. In December, what we've started to see is that in December, what we've started to see, I think, is the Chinese growth assets have started to come through, which is, I think, very positive for us, all else equal. So essentially, I think our concluding statements is that for 2022, we were pretty much on the back foot because of the squeeze on the Chinese exposure. Although it started to work out well in December, it had caused a lot of pain. In January, a lot of things started to align. The Chinese call is working, the dollar call is working, global bonds have started to rally, South African bonds have started to rally. And I think pretty much a lot of things are in our favor. But again, it's way too early to sort of claim victory. We still have another 27 months to go. And there's still a lot of very complicated macroeconomic variables that the market has to digest. So we could pretty much say BIP is still very, very anxious, but we think that a lot of things are confirming what we sought to achieve with our de-risking call. We would have been less anxious if our 2022 numbers could show that we're de-risked. Unfortunately, they almost look like we took on more risk. And I guess it is what it is because of how these things are taking time to sort of work out for us. What are we most concerned about? We still think that the dollar can surprise, especially if something goes wrong with Russia and Ukraine. Maybe Xi Jinping does something very, very unexpected, maybe invade Taiwan. You never know with these geopolitical risk issues. So although the dollar is weakening in our favor, it's very difficult to say this is now the case. It's working. So we're still concerned about that. There could be another relief rally. Who knows what the Fed is going to say tomorrow? And I guess that's something that we're just going to have to live with. We are very concerned that in these relief rallies, your DM growth assets will outperform EM, like happened, especially in the third quarter, but then reversed in the fourth quarter. We are worried that there might be an unanticipated stalling of the China reopening cycle. I don't know, maybe a new variant comes out of China and it affects the whole world. You never know with a lot of these biological geopolitical risks. And unanticipated reflationary policies out of US, maybe they have aggressive tax cuts like Trump did in 2018. And all of a sudden, what we thought was a very expensive asset starts to rally indiscriminately. And then with South Africa, we don't know how the energy crisis is going to play out and all the political tensions that we're still grappling with. So essentially, these are the many things that still need to play out. Although these things worry us, the truth is they actually almost vindicate or justify why we need to stay with a lot of defensive assets, all else equal. And then last year when we met, I think our biggest concern was that real data was very depressed. In fact, it was weakening and heading into a recession. That hasn't changed. Nominal data being inflation was very elevated. Although it is starting to weaken, it's still at very, very high levels. And we don't think anyone can sustain a bench press in either condition. So that's really bad. And if the Fed remains determined to destroy inflation, which is pretty much this bench press, then they possibly are also going to break something that hasn't really changed. Fast forward to this quarter, our positioning, I think we're going to summarize as defensive in the sense that we still have about 14% of dry powder, vulnerable to relief rallies, vulnerable to the fact that the downside risks or the economic recession can be a lot worse than we anticipated, and vulnerable to the fact that maybe the yield curve is wrong and then we shouldn't even have de-risked. So we don't really know how it's all going to play out, but there's a lot of vulnerability. And then pro-cyclical in the sense that although we are underweight SA equities, although we are underweight DM equities, we still have equities, and that is something that you only hold if you're cyclic, if you think the economy is going in the right direction, which it isn't. But we're also not going to sell out all of our equities because that becomes a very aggressive market timing risk. We have added to things like Chinese equities, which in the bigger scheme of things, those are cyclical exposures. And then our global equity benchmarks, as you would know, is not a DM benchmark. It's 70% DM and 30% EM. That 30% EM, even though we've kept it at neutral, is still a cyclical idea. So we pretty much have the combination of pro-cyclical ideas, which will do very well if China continues to reflate, and obviously vice versa. We're vulnerable in our underweight to South African equity market and our underweight DM if we turn out to be wrong. And then we're very, very defensive with the 20% or 15% rather, if we turn out to be correct. You sort of need, I think, a blend of all of these in the portfolios to position for different scenarios. So what I'm going to do in the next couple of minutes is to just take you through things which justify us being defensive, things that explain why we're vulnerable, and some of the things that actually favor a pro-cyclical positioning, and how we sort of try to combine this so that our portfolios are positioned for multi-scenarios. A much, much cleaner and visual way of illustrating exactly how we're positioned is none other than this particular chart of gymnastics. And I'm going to really try and explain what this really is trying to do. There are three pieces of a portfolio that you can think about. There's the equity market, which for most part is still fighting with the Fed. So we've seen how since October, the equity market is rallying because they really think that the Fed is going to start cutting interest rates very soon. Unfortunately, if the equity market is wrong, and if you look at this particular posture, it is very exposed to a very dangerous outcome. I mean, either this leg breaks or this particular person, like I think, pivots incorrectly. We don't really know how it's going to work, but the equity market is not in a good place at this particular point. I think is the first point to make. The second point to make is that everything really rests on the Fed, and they are the foundation of interest rates, which is your bond market, the middle gymnast. So I think essentially, for as long as the Fed does not pivot, your bond yield is most likely not going to rally, which means that the discount rate that could be applied on weaker earnings remains elevated, and that's not a good thing for the equity market, although the equity market is fighting that. What we're very lucky, I think, what we're very fortunate is that fortunately this middle gymnast, being the Treasury, has not rallied. I think they're carefully studying inflation trends, they're carefully studying data. And I think once the bond market is convinced that the Fed has won the fight against inflation, you're going to see a strong bond market rally, which we are positioned for with our exposure to global nominal bonds, more recently global inflation-linked bonds, local ILBs, local gold. All of those play into this particular scenario. And then in the scenario where there is a market which has already gone through all of this, which is the Chinese market, and starting to reflate, that exposure also really helps us. So essentially, our vulnerability really comes with this relief rally because we don't think the Fed has moved an inch at all from hiking rates. And also the fact that the bond market hasn't moved makes the equity market vulnerable to being wrong. And that's essentially where we are at this particular point in time. Obviously, a pivot that allows your bond yields to come back to the floor, which is a rally, would essentially then allow us to take a lot of profits and buy into the equity market. Because as you can imagine, once these two sort of flex out or relax a bit, this is not a comfortable posture. It's probably going to end up crashing. And I think this is the visual illustration of how the portfolios are positioned, or else equal. We are still very scared there's going to be an accident somehow. And we think that the accident is really going to be manifesting more in the equity market than it will with the Fed or the bond market, because the bond market actually hasn't rallied yet because it's extremely careful around these particular issues. If you go back to 1982 or 1984, which is one of the regimes that has been used to talk about today, you saw how bond markets pretty much weakened last year. Then they spent a good 12 months trying to understand if the Fed was going to win the battle against inflation before you then had this ultimate rally. Essentially, this is where we are, where as the yields in bonds have been increasing, we've increased our exposure to bonds both locally and offshore, and we are pretty much now sitting with very aggressive overweights on both local and global bonds. We expect that the bond market could stay at this level for pretty much 12 months, which means that this could be the case all the way to March or January next year before we see this very aggressive rally. What's very important to note is that the bond market is not going to rally until it's convinced that there's inflation, there is strong disinflation. But another word for strong disinflation is a recession. And as soon as the bond market, I think, starts to pick that, it will have to rally, which is in a way a positive thing for equity markets, because equity markets need clarity around the discount rate to use for earnings. So what you end up having is a discount rate that's being lower, that will potentially come with earnings crashing lower, and then you can start to have a sustainable equity market rally, which is actually explained quite nicely in this chart to the further right, where the equity market pretty much takes a while to identify its ultimate bottom, but this ultimate bottom never happens until the bond market confirms it. So pretty much the sequencing of events is one where there's a bond market rally to show that things are now dangerous, which creates a low discount rate. As soon as the equity market has got a low discount rate, it has this sustainable rally. But between then, in this 12-month period, when your yields are flat or range bound, the equity market comes with a lot of aggressive, violent relief rallies. And we think once the one which resulted in the equity market rallying by 15% locally and 4% globally in Rand is one such relief rally, which is ultimately going to again result in another sell-off when the bond market starts to price in a recession. So an easier way of characterizing BIP's positioning right now is that until the bond market confirms it, we're not buying a lot of equities. Pretty much until this particular person, like I think, relaxes their posture and allows the equity market to settle, we're not interested in such a risky positioning. Or else again, this is pretty much a very good way of illustrating where we are. And then if you sort of look at the yield curve again, since we sort of last met with you, it has gone deeper. I think that the other part that's very, very concerning is that the 10 versus 2 years gone deeper, the 10 versus 3 has gone deeper, the 5-year versus 30-year have all gone deeper, suggesting that the risk of a severe economic contraction is actually increasing and not reducing. And hence the reason why we're convinced that the recent rally in equity markets is pretty much, I think, going to come back again to another bottom, because it's rallying when the fundamental risks to those earnings are increasing, which we call euphoria, or pretty much a bear market rally, or else equal. So yes, we might have underperformed because we lost out on the equity market performance since October, but we're not concerned because the risks that caused us out of the market are still very, very elevated. If you then look at it from a very different angle, which is this is a global census on the major managers of money to get a sense of what they thought about a recession. You can see between June and September, when we were de-risking we started de-risking our portfolios in May, the risk was lower than 30. We'd concluded in September when it was now a 50-50. So from a timing of our de-risking, we think we're fairly responsible, because by the time it tipped over from being a balance issue to clearly downside, we were already very, very conservative. And we're also quite convicted in the sense that although we're missing out on the relief rally, it is happening as the downside risks are increasing from 60 to 75 to 65 to 70, and it's probably a lot worse. We're very aware that this is probably one of the most anticipated recessions globally. I think everyone is saying that, and we agree. Where we then come in is to say the detail around that overly anticipated recession is not homogeneous. There is not a homogeneous view around what is the magnitude of the economic contraction going to be. Is it just a growth slowdown? Is it a soft landing? Is it a hard landing? What is a soft landing? What is the asset allocation for a soft landing? There is no common answer around that. How long will that last? When is it going to happen? What is the effect on earnings? Is it a sharp earnings contraction, deep earnings contraction? How long will those earnings be in contraction? When will it start? When will it end? So everyone anticipates a recession, absolutely. Ask them all of these questions, and then you start to see how diverse the answers are and how diverse the asset allocation suggestions are. And I think this is where we say being the most anticipated recession, it's got nothing to do with the downside risk that comes with it, because the downside risk that comes with this anticipation is in the answers. If there was one global answer to these 6 questions, clearly this would be in the price. The fact that there's so many answers to these 6 questions means you can never make a comment that this recession is well priced in because it's 70%. Yes, it's 70%, but with no answer, with a lot of confusion, a lot of uncertainty, which is obviously being expressed with this equity market volatility. If we could find one answer for all of these 6 questions, we would be so convinced that it is in the price and would start to use our dry powder. Unfortunately, we've got a lot of access to research, and the diversity of views around this is actually very scary, to say the least. If we then try, and we've sort of tried to look at our own internal research providers that support our process to answer these questions, and we pretty much have created a table, which is what you can see. If you look at the BIP house view, for one, we're not going to answer any of these questions. What is very important to us is that when this is inverted, you're going to have an earnings contraction and a growth contraction, and you need to be defensive. And you need to accept that these are extremely difficult questions that no one can ever answer. So we've pretty much stayed out of that conversation. We have, however, highlighted that there's risk to earnings, there's risk to equity. So we need to be very conservative. When it comes to when it could happen, all of these things we don't know. But if you look at Alpine Macro, our research provider, they think there's a high chance that it's going to be a soft landing when it comes to the economy. However, they actually also see a lot of signs that suggest that we could actually have a sharper than expected economic contraction, although most of the world is expecting a soft landing. The soft contraction for them means that your earnings contract by roughly 15%, but the severe one means that your earnings would easily contract by more than 20%. Alpine Macro, they're very smart people and they're very aggressive. When are they expecting this to happen? They actually have a very high conviction call that all of this is going to come together this quarter. So they're expecting quite a sharp sum to happen between now and 31 March. They believe it's happening, and they've got a lot of evidence to confirm that, which makes us extremely scared because it makes us think, do we actually have enough dry powder if it's going to happen this fast? We don't even know what the answer to that question is. They expect the latest time for this recession to occur to be in the second quarter, and they actually then expect to move from 10% underweight equities to 10% overweight equities in the second quarter of this year. So pretty much, when will this happen? They think it can happen anytime in the coming 3 to 6 months, and it can be much sharper than anticipated, which is not a good thing or else equal. Then we've got the BCA, which has got a GIS strategy, which is convinced it's a soft landing. They're not really entertaining any other scenario. They think that will come with contraction in earnings of 10 to 15%. And they think this is a story for the final quarter of this year. And they think between now and the final quarter of this year, you should be overweight equities by at least 10%. So very, very bullish for the first 9 months of the year. And then in the final quarter, they sort of start to cut back their equity exposure. Worst case scenario, they think all of this is going to work out in the first quarter of next year. So pretty much a very risk-on strategist. Alpine Macro, a risk-off strategist. So both of them anticipating a recession, but the asset allocation response being very different. And I think this is a point we really want to leave with you to say, anticipation of a recession is very different from pricing in it, because pricing it in is a function of your asset allocation responses. The rest of the BCA actually disagrees with their global investment strategies in the sense that they actually think you can have a soft landing or you can have a worse than anticipated economic contraction. All other strategists within the BCA definitely think that although you can debate around whether it's going to be a soft or hard landing, when it comes to earnings, it's definitely going to be a severe earnings contraction. There they are in common agreement. So if you sort of then start to combine all of these views, all we know is that you really have to be defensive. They think that by Q4 of this year, all of this should have played out. Otherwise, it's going to play out in the first quarter of next year. And then there's Ned Jefferson Research, who is the support or the backbone of BCA. They do the inside research. They think both possibilities, both a soft and a hard landing is possible. They've got a 65% chance of a severe economic recession. And they also feel like you could have severe earnings contraction, and the timing is quite similar. So I think if you sort of look at all of these views, these are all very smart people. They've got much bigger teams than us. None of these views you can dismiss, especially if you go through their logical arguments. What it really just means for BIP is that please stay defensive. and rather look at your re-risking criteria to decide what you need to do from a de-risk position. There is no need to run an overweight equity portfolio like BCA GIS is doing now in case Alpha and Macro is wrong. And there's probably no need to run an overly defensive portfolio in case BCA is wrong. And we've tried to find middle ground in how we are positioning our portfolios. Now, if we go to Ned Davis, which is expecting where they've got a 65% chance of a severe recession, that will come with a contraction in earnings of 35%, and it will last for 17 months from when it started in April last year. So if they are correct, we are going to have a 35% earnings contraction, and this 17 months expires in August of this year, which is essentially saying between now and the third and all the way to the third quarter, we should see earnings contracting by 35%. They've probably contracted by 10% now, meaning there's another 25% to go. And the probability attached to this is 70%. And if they study a lot of equity market cycles and this plays out, you're pretty much going to have this profile where there's this downturn and then a final sustainable rally in the later half of this year, which will take your equities to a performance of 12% if you start off at 100. So in our view, if I look at this and then a rally all the way to 12% and imagine that I can get 11% from a South African bond without any capital appreciation, I don't really see why we should be taking any chances with equities whatsoever. If we look at a second scenario where there is no recession at all, to which they attach a 30% probability, best case scenario, you end up by 16% at the end of the year. This is pretty much, again, South African government bond coupon of 11 plus a 5% capital gains in such a risk-on scenario. Again, it's not worth chasing this 16% if you think of things that can get a lot worse than this. Then they've also drawn a different way where they've studied a lot of equity market cycles for the S&P. And they, again, look at a scenario where you've got no recession, and they also consider that there's a presidential cycle happening. And they think a typical profile is one where the equity markets are going to rally for the first half of this year by roughly 9%. Then they're going to become range bound before this final rally. Again, if you look at this number of 10.5%, it's exactly what you're getting out of South African bonds. So in the scenario where the equity strategists are very bullish on equities with a 12-year view, it doesn't really put us in a scenario where we wish we had more equities. We still prefer to remain very defensive, especially because it doesn't come with that earnings contraction. It doesn't come with any currency risk. And for all we know, we have no idea how the Fed wants to manage this cycle in any case, and the bond market is still disagreeing that the inflation story is gone. So we're pretty much going to stay as defensive as we possibly can. The chart that really worries us is this chart that you're seeing to the left. So clearly there's this anticipation that there's a 70% chance of a 35% earnings contraction. If you look at this particular chart, the green line that is broken is your wage growth or your unit labor costs, and it is inverted, meaning that when it is rising, those costs are actually coming lower. And when it is declining, it means your unit labor costs are increasing. And you can see how they've increased quite significantly recently. They have a close relationship with the margins for US equities. And essentially, every time this drops, this should drop. So I think what you can see is that there's a very strong gap or big gap between where your corporate profits are and the cost. And essentially, these have to align. And I think this is the argument, I think, that the Fed has to say this has to weaken. And there's two ways the Fed can weaken this wage growth. They can ask companies or force companies or issue a decree to say you shall fire people, or they can actually just attack this and make sure that it is weak enough to force this. You cannot force companies to fire people, but you can definitely make it very difficult for these margins to support wages at this level. And I think this is pretty much where we are. And if these margins just normalize from roughly 15 where they are to a much more normalized number of 11, and essentially like move to 11, and they still can produce a sales volume of 5, which is, I think, too aggressive when you have a recession, you're pretty much looking at a downside risk of 22% still to go. And given the rally we've seen, this is probably now 32%. I think it's just pretty much, again, reaffirming us to say the earnings risk is way too elevated for us to give up the dry powder that we've managed to build. And I think this other chart is a good one, which shows the difference between the performance of equities and bonds. And what it shows is that in many, many gray shaded areas, this line goes negative, meaning that your bonds outperform equities. And this is the stage which we're waiting for, where we're going to see that final rally in bonds if bonds believe that there's going to be aggressive disinflation or there's going to be a recession. And typically when that happens, as your bonds are rallying, your equities have the final sell-off, which makes this negative. And essentially at this point in time, it's now at a make or break. The only scenario where we might buy equities if this starts to go back upwards because the whole thing was wrong, or if it's actually confirmed. Either way, this forces us to stay in bonds until there's clarity around which direction we want to be taking our risks in, or else equal. And then if you come back to the scenario where you're expecting a recession, but there's an equity market with such elevated earnings, our only concern is that there is a lot of room for earnings disappointment. Remember, for the resources, for the resources sector, some part of this sharp incline was because of artificial commodity prices because of the Russia-Ukraine war, which if they actually normalize to remove that abnormality and then come back to much more normal levels, that's quite a lot of downside earnings risk for the SA equity market, which is why that's where we have the biggest underweight of 10%. And then if you look at China, this has got a different problem where it's already bombed out. They've already gone through the worst. They actually have a lot of significant pent-up demand. If you look at what happened in 2020, 2021, 2022, a lot of demand destruction because of the COVID policy, which pretty much got the Chinese economy to start to operate at 60% of its capacity. It's expected to rise to 80% by June, which is pretty much this number, and is expected to then enter into this post-pandemic boom where it then moves from 80 to 100. And given that we're starting from a very low point, if you ask me to choose two cyclical assets, this one with extremely elevated earnings or this one with bombed out earnings and good demand, no Eskom issues, we think this is a better way to play the South African equity part, which is what we did when we bought Chinese equities twice, 5% and then another 5% across our strategies. If you also look at the Chinese story, this is the amount of money that is accumulating in banks since they got into their zero COVID. So pretty much almost 10 trillion Chinese renminbi has been accumulated, and there's pretty much no loans taking place. And with all of the zero COVID restrictions removed, as this money is spent back to 10 trillion, that's significant amount of demand that we've already positioned for. Fortunately for emerging equity markets, whilst for South Africa, the earnings are extremely elevated, for emerging equity markets, you can see how the forward PE is already severely crushed as the Chinese business cycle was weakening because no one was spending, the money was building up in the banks. As this money is deployed, we're expecting the Chinese business cycle to start to turn up as it has done. Obviously, it's very, very early, which is why I think we experienced that final pain because we got in a bit early. But I think as this unwinds, we are expecting it to lift up emerging equities as well. And because we've got a 70-30 benchmark towards EM, there's no need for us to buy any more EM. It's already our strategic AA. We think it's going to benefit us over and above the 10% allocation we took away from South African equities. And then if you sort of look at this chart, the previous chart was looking at emerging markets using your forward PE. The next one is looking at the same particular one. This time around, we're looking at our trailing PE. And again, this is pretty much coming off a very depressed angle, especially when your emerging markets are possibly going to start to cut interest rates because their inflation numbers are starting to look good because obviously they also started to hike rates a lot earlier than DM. And another tailwind again for emerging markets is the fact that the dollar looks like it has peaked. So if you look at the EM versus DM cycle, I'm looking at this particular chart, every time the dollar is rallying, EM struggles, and every time the dollar is weakening, EM outperforms. It has been underperforming, which has hurt the best blend series, and a lot of your funds who've got exposure to EM like us, but it looks like we're pretty much on the cusp of a turnaround if the dollar maintains the weakening trend that it has had for much of December and January, so which again, I think is very constructive for how we're looking at the world. So I think the BIP house is at a make or break. Some of our clients have started to buy into EM. Some of our clients are waiting for this to sort of turn around. But either way, this is an idea that we're well versed with because of the pain we've experienced for the last couple of years. And I think also because we are studying a lot of these things because it's extremely critical to us. So what has happened to our global equity carve out is that this is our neutral benchmark, which is 70-30. We have maintained it at 70-30, except it has changed to 60-40 because there is a 10% active bet towards Chinese equities, and there is still 60% DM. So we haven't really discarded our DM bets at all. We have kept them. It's just that we have added a bit of Chinese equities because of the starting point. So I think the fact that EM has maintained this painful posture despite all of the rate hikes happening suggests that it has a lot of resilience. And if China's reopening is quite aggressive, all of a sudden you've got some fuel to something that's already so bombed out, which is making us quite excited. But the truth is that it has also really caused a lot of pain to our clients. We just want to revisit the South Africa story to say, is there a scenario where our 10% underweight equities, South African equities in favor of China is a little bit overdone? We can see how current earnings expectations for resources are still fairly bullish. I mean, there's an expectation for this to only weaken by roughly 10% on average, which if we have a sharper than expected recession, I think this is a very optimistic number. So this makes us comfortable that I think the China way is a better way to play this. What scares us, obviously, is this earnings upgrades that is expected to come out of Naspers/Prosus of 98%. We all know that Naspers and Prosus is a very big part of the JSE. If it has earnings growth of 98% this year, it means it's going to double up in its price because prices follow earnings. The Naspers is 25% of the JSE, or roughly that number, or maybe slightly lower, but it does have a big impact. So you can imagine if you've got 2 or 3 equity managers with this in their top 10 holding, how that can actually change your portfolio performance in a very aggressive way. That sometimes makes us very concerned about a 10% underweight to South African equities on condition this number 98% is practical. If it's not, it's a different story altogether. But if you look at a lot of Chinese equities and EM benchmarks, they actually have exposure to a lot of Chinese technology. So to a meaningful extent, we actually will be able to participate in this particular one, but without the concentration risk of just Naspers or Prosus, but a much wider range of China technology, which has got the same earnings profile anyway. So on the one hand, it's not a concern because of the manner in which I've argued it in, but I think it's fair to say, if someone can have a high conviction bet on China, on Naspers in your equity managers, they could do a lot better than the diversified tech stocks in an index. So we do acknowledge that it is an area of vulnerability, no matter how we look at it. What then makes us very comfortable having acknowledged that is that when you look at this particular chart, I mean, the best way to look at this chart is to look at 3 particular scenarios. There's one scenario which looks at the typical sell-off of these different industrial equity sectors when there's a recession, and then one when there's no recession, and then where we are currently. So the dark line is a recession bear market. This tan chart is pretty much a non-recession bear market. The most critical thing to note is that only the growth areas have sold off in a way that is at least consistent with a no-recession bear market. The rest of the equity sectors haven't really sold off, if you look at the blue line, anywhere close to a recession. And the areas which have not had big downturns are your cyclical growth assets, which is South Africa as well as China. What I'm really trying to say to you is that whilst your value managers have done a lot better in this recent cycle, it's because their valuations are not yet reflecting a recession. So yes, you might have the protection of a value manager like your Alan Gray, maybe your PSG, etc. But if their sell-off starts to reflect a recession, they probably are going to incur quite a lot of pain. And this is where, again, we start to realize that although we sometimes get nervous around our South Africa exposure, it actually has been performing in a manner that is not consistent with a recession. If you look at these blue lines, which is sectors that are typical of cyclical growth assets. So we could say, whilst your tech guys or your growth managers like your Sands Capital, and your quality managers like your Franz Smith Blue Alpha have actually sold off very aggressive. If you look at how the blue line is relative to typical periods, your value managers are not really reflecting such a scenario. And from that angle, we become very comfortable to maintain our 10% underweight South Africa in favor of China, which is already really bombed out. Anyway, like if you come back to basics, it's very difficult to have conviction on anything until the Fed declares victory over inflation. I think that's what it ultimately comes down to. But understanding that even if they have a pivot, they typically pivot because the fundamental risks are now very dangerous for the economy. So the early part of a Fed pivot actually comes with more downside risk for equities, although we definitely want to see that to start to increase our risk appetite. And if I sort of come back to this particular chart, a few things are quite clear. The global equity market in general is still fighting the Fed and is very vulnerable to a further downside as the Fed proves that they're determined to keep on hiking rates. China, on the other hand, has already lost its battle with policymakers. I think we also how they were hiking rates for most of the last 2 years. They're cracking down on their technology companies and pretty much left a lot of blood on the streets. So it's done and dusted. The bond market has played it extremely safe. They're waiting for the Fed to make up their mind before it rallies, and we're building up exposure in the bond market, in Chinese equity market, but avoiding everything else on the growth side. And we're understanding that even if the equity market turns out to be correct and the Fed pivots, in 2015, in 2016, as well as in 2018, the equity market and the Fed were again engaged in another vicious battle like is happening today. It turned out the equity market was actually correct. But guess what? Although the equity market was correct, by the time they proved that they were right, they had already been destroyed. There was a lot of equity market losses and there was a lot of damage to the stock market. And I think this is where BIP would say it's far more important to lose an argument with your money than to win an argument without your money. We're not going to win this argument without our money. So I'd rather be defensive, wait for the guys who want to fight. And when they're done, I think we'll come back and we start to buy what we need to buy with our portfolios, regardless of the short-term pain that it has caused us. If you sort of look at this particular chart, the quick message is really trying to say is that the Fed is a little bit more pessimistic on inflation than markets. Markets are expecting quite fast disinflation, and the Fed is not. Markets are expecting an early pivot and quick rate cuts. The Fed is expecting a slower pace. This is a simpler way of just saying the Fed is going to run a counter-cyclical monetary policy until it is convinced that it has destroyed inflation. To give you a sense of how bad things are, I'll sort of draw your attention to this US lead economic indicator. Historically, every time the lead economic indicator goes lower than 1, the Fed automatically starts to cut rate, and you can see they start to cut rates very aggressively. So in the early 90s, the lead economic indicator, where the cycle went below 1, the Fed went into a cutting cycle. And then around the early 2000s, again, the lead economic indicator went below 1, the Fed immediately started to cut rates aggressively. We had again another scenario in the around 2005, 2007, the lead economic indicator went below 1, there was a pause. And then they paused, I think, assessing, but as soon as it resumed the trend, they started to cut rates very aggressively. This time around, you can see how deep the lead economic indicator is, and the Fed has not, pretty much the Fed has not moved. They have not, I think, been concerned at all. And I think we're just saying, how does one argue for a soft landing when this precedent has been broken with the Fed that still wants to hike with 2 more rate hikes of 25 basis points? We're not convinced there is any need to celebrate a reduction from 50 to 25 if they are hiking with such contraction in the lead economic indicator. And this is pretty much unprecedented. It has actually never happened, which is again showing you why we really don't think there's any need to even position for a soft landing whatsoever if you look at this chart. If you look at the global manufacturing cycle, and again, you look at the cycles, every time this went into contraction, the Fed automatically started to cut rates quite aggressively. This time around, the global manufacturing cycle is deeply negative. The Fed is not moving. They're pretty much hiking rates. So essentially, they are running a counter-cyclical monetary policy stance because they want to address the inflation issue. If you then look at your monetary financial conditions, deeply negative. I mean, they've kind of moved now because of this relief rally we're seeing. But once that fizzles out, I think we're going to pretty much see high risk of an economic contraction. And then if you look at this particular chart, it's saying as much as we all really want the soft landing, it has never really happened. And I think the $1 million question for BIP is, what is the asset allocation for a soft landing anyway? Like regardless of the fact that we may or may not have it, how do you position for such a scenario? The reason why we ask that very important question is that Soft landing, according to economics, is when you reduce inflation or supply gradually without reducing unemployment. And then you get to the sweet spot of the curve where if you move 1 more centimeter, you're causing a recession. And if you stay put, you move here. So if you think of the analogy of gymnastics, where like they'll do their swings and then they like kind of land on the ground, then they walk away. That's not how it works with a soft landing. You don't land and then you walk away. When you land here, you have to keep perfect monetary and fiscal policy, which is neither too tight nor neither too loose. Now, how does one even then asset allocate for a scenario where one wrong move, it either goes here or back to inflation? What is the asset allocation stance for that? So as much as I think the market is celebrating a soft landing, I'm not so sure it's easy to tell. How do you do it if you know one wrong move, the Fed is hiking again, and one wrong move, they are cutting rates aggressively because they've broken something? So in our view, this is a very tense status quo for a market where they still Russia, Ukraine. There is still the possibility of Trump coming to office next year or Biden coming for re-election. I don't really know what you can think of from a geopolitical scenario, but to stay put here, coming from here and do enough and not make a mistake, I think is an impossible assignment. So either way, we just think soft landing, as much as the market wants it, is a very difficult environment to manage money in. I almost feel it's better to just crush the whole thing and just like, at least you know what you're dealing with. Fortunately for us, China is already here where it's happened. They're starting to crawl their way back up here, which is where we are. The US is on its way down. We don't know exactly where it's going to stop. And Europe is somewhere here. They're all hoping to stop here, but no economy has ever managed to land there, which is pretty much what the essence of this graph is. And then the biggest multi-million-dollar question for us is that there is expectation for a soft landing for an economy that got 5 hectic bombs last year. And what I really mean by this is if you look at our fiscal policy, when this line is going negative, it means government is releasing a lot of resources so that they can support underlying economic growth. When this line goes high like it does, it means there's a sudden withdrawal of fiscal policy. So essentially what happened last year is that there was this aggressive fiscal shock where there's extreme support and extreme withdrawal. The economy still has to adjust to all of this, and we don't know how it's going to adjust, but to expect a sudden withdrawal of fiscal support to land softly, I don't think so. I just think that the market is understanding that there was this bomb. And then as this was happening, there was another atomic bomb delivered on the US where there was this aggressive strength in the dollar. And then over and above that, there was then this aggressive hike of interest rates, which has actually only been done once. So you've got aggressive removal of fiscal support, aggressive attacks by the dollar, aggressive attacks by the Fed, aggressive increase in real interest rates from pretty much negative all the way to 2%, which historically causes a recession, and then an aggressive hike in labor costs. So to think that an economy gets punched 5 times, and then after being punched 5 times, it lands softly, I just think it's over-optimism. There's a lot of complacency in the equity market, and this pretty much justifies why we think we should be where we are. For an economy like South Africa, if you get hit with a fiscal shock, strong rand, high real interest rates, very aggressive hike of interest rates, and very high strikes, whatever you want to call it, the release valve for South Africa is normally the rand. It weakens and then it protects the economy from shrinking. Now, the million-dollar question is, which of these 5 factors do you think are going to be the release valve for the US? We are arguing very strongly that there is no way government will suddenly start to spend again, especially because there's a hung house in the US with the Democrats and Republicans. So we are not counting on a sudden stimulus again from government, so we can remove this as a fiscal, as a release valve. The dollar, let's just park this for now. Fed, they're clearly hiking into a tight economy, so they're not going to be the release valve. The labor market is too tight, it's not going to be a release valve. So if you think of these 5 major shocks to the US economy, which is causing that lead economic indicator to contract, and you ask yourself, what needs to happen for the US to land softly? It's obvious that the dollar has to weaken and the real interest rates have to crash back to 0. Now, from an asset allocation perspective, if you want to make money when there is all of these shocks, you have to go and buy the release valves in a direction that makes money for you. So for the dollar, you have to buy anything that works when the dollar is weakening. And then for real rates, this becomes things like your global inflation-linked bonds, because as these real yields are coming back to zero, that's how your ILBs make a lot of money. So if you sort of look at our re-risking criteria, we had signals like your real yields too elevated, and I think this is pretty much where they are, and the dollar too elevated. The other three factors we don't think are going to be dependable release valves for the US economy, which brings us to these three particular parts to say, what is going to break to allow the US economy to land softly? There has to be an aggressive weakening of these real yields back to where they were in January, which is in the negative space. Your real yields can only crash if there's a recession. And if there's a recession, your ILBs rally because they are the ones which are priced off real yields. So you will find in the recommendations we're going to be emailing you later this evening or tomorrow morning, we are encouraging that we increase our local ILBs by 2.5% because the real yields are elevated, and to introduce a 2.5% allocation to global ILBs. You will see a few of our recommendations are geared for a weak dollar because this is actually the easier release valve compared to this one. So we expect the dollar to weaken, not because the dollar is expensive, but because it's the only thing that can save the US economy from crashing after these 5 attacks. And you pretty much then introduce any dollar play. And I think in our recommendations is a 2% allocation to global gold and a bit of Chinese equities, which really work well with this. And then to some extent commodities, but we think that that's a later call. And the only other release valve, I think, is either the labor market breaks or earnings crash. And if you want to benefit from earnings crashing to release that pressure, the best way to do that is to be underweight equity. So I think our final point is that soft landing after 5 major bumps, impossible. Rather think of the things that need to happen to release the pressure. And I think the things are your real yields, the dollar, and earnings crashing. And this is pretty much represented in our asset allocation, where we've got the defensive positioning, which I talked about. And then we've got the pro-cyclical plays, and then we've got the areas where we are underweight equity markets that are most vulnerable. So if we sort of come to a conclusion, for us to sort of have a sustainable, rally in equity markets, there has to be a release valve somewhere. And this release valve is not going to happen until these real yields drop, which is the first point to say, we're going to need a lower discount rate, which is lower real yields. But this lower real yields is not going to happen until the bond market rallies. So you actually have to go and wait in your nominal and ILB bonds, wait for them to rally, which then gives the ultimate bottom for equities, and then you move over to equities. And obviously, the bond market is going to watch the Fed to decide if it's one, and the Fed is going to be watching the bond market. So there's this virtuous circle where the bond market looks at the Fed looks at the bond market, but either way, one of them is going to have to confirm victory before we can even be bullish on a sustainable rally in equities. And if you then look at how we bring all of these arguments into portfolio positioning, we're pretty much coming back to say, we need to know what the final number for earnings is going to be. We don't know that until the recession has happened and earnings have crashed enough. We need to know where the Fed is going to stop. We don't even know where that is. We do know, however, that the Fed so far has hiked by just over 400 basis points, and they want to hike by another 50 or 100. Who knows? We'll find out tomorrow. But if you look at rate hikes from 5 to 9, that's 400 basis points. And if you then try and apply any of these earnings contraction, the possibility of downside risk, in our view, is still material. We're not saying it's 67, 56, 43, or 25. We just know that this is a lot. And the probability that this can happen after these 5 shocks is extremely high in our view. So on that basis, we're pretty much going to stay defensive. And we're going to continue to watch a lot of our re-risking criteria to buy into a lot of these things. When you study our re-risking criteria in a lot of detail, you're going to find that a lot of them are linked to the unwinding of a lot of these things. So essentially, as this unwinds, our risk appetite increases. That is essentially the easiest way to think of the BIP re-risking criteria, which I'm not going to go through in a lot of detail. We're also looking at the asset allocation direction that is implied by the different houses. In effect, they've communicated it. So far, BIP is negative on equities.
positive on bonds, both nominal and ILB, both local and global, because of that whole release valve argument I gave you, and underweight cash. BCA on the other end wants to be bullish in the first 6 months of this year and then neutral everything in the last part of this year. The rest of the BCAs are aligned to Alpha and Macro and ourselves, where we're pretty much running the first quarter very defensive. And in all cases, the underweights are at least 10% underweight equity. So they were also quite aligned. Where we are different, however, I think is the fact that Alpha and Macro thinks they're going to switch over to a bullish stance literally next quarter because they're expecting a crash this quarter. Let's see what happens. If they're right, I think we would love to just get over this and move on. If they're wrong, it means the pain is going to be prolonged a little bit longer. And then the other BCA think this will all be playing out in the whole of this year. And then we don't know what is going to happen, but we know that regardless of who is right, BCA, GIS, BCI overall, or Alpha and Macro, it will be picked up in our re-risking criteria. So we're just going to say if it confirms what we have as a re-risking, it doesn't matter whose view it is, we're making the requisite change to your portfolios. But for now, we're pretty much very quite defensive in our positioning. This is a table that is in two halves. There's this part and this part, which gives you a summary of how we're positioned. I don't really want to spend a lot of time on it because we're going to discuss that a lot in our meeting. But if you look at some of the things we have is we've got a 2.5% overweight global bonds for our South African multi-asset portfolios. And then we're 10% overweight for the global multi-asset. In fact, this number is now 15. And then if you sort of look at the two calls we're sort of introducing, it's a 2.5% overweight for South African ILB. So this is a recommendation you will have in your inbox this afternoon or tomorrow morning. And then on the global side, we also want to introduce a 2.5% overweight ILBs. And then the other things I think that we can also mention is, if I'm skipping a lot of these things, is that there isn't a recommendation to consider an allocation up to 3% maximum in global gold for South African multi-asset portfolios and 5% for global multi-asset portfolios, just to play into those release valves that we sort of mentioned a lot earlier. So a lot of recommendations just to bring in defensiveness to your portfolio, a bit of vulnerability, and then some pro-cyclical exposure. And we're trying to mix this in the best way we know how to. I think your role is to just study our recommendations and then adjust them for your own risk appetite. If you want these to be implemented immediately, you just have to pretty much send an email to us and say, please implement immediately. Don't wait for the meeting. If you want an online meeting before our actual investment committee meeting, please let us know. We're quite happy to do that with you. Effect the changes before we see you. If you want to absorb all of these recommendations until we see you, we're also pretty much happy with that. We also have recommendations for the multi-asset portfolio. There's pretty much nothing to change here except of the possibility of introducing the Press China Balance Fund as that rally we're expecting starts to gain a lot of traction. This is pretty much, I think, what brings me to the end of our views for this particular quarter. Thank you so much for the time I think you've dedicated to us. I'm probably 6 minutes over time, but I do hope that you managed to understand all of our arguments. For any areas where you need more emphasis, we're going to be meeting with you in the coming few days. You're also welcome to give us a call. You're welcome to send us an email. There is no need for you to wait for your investment committee meeting to implement some of these recommendations. We can pretty much do them right away, but they are already approved by the BIP Investments Committee meeting. Until we get your call, your email, or until we see you at your offices soon enough, this is goodbye for me. Thank you so much for your time and support. We appreciate you. Goodbye.